Now let me turn to introduce our speakers today. Our first speaker is Peter DeMarzo. He's a faculty member at the Stanford Graduate School of Business. In addition to his experience at the Graduate School of Business, Peter has taught at the Haas School of Business and the Kellogg Graduate School of Management and was a visiting scholar at the Hoover Institution. He's a member of the National Bureau of Economic Research and past president of the Western Finance Association. His research is in the area of corporate finance, asset securitization, financial contracting, and market regulation. Recent work has examined issues of the his recent work has examined issues of the optimal design of securities, optimal compensation mechanisms, regulation of insider trading and broker-dealers, bank capital regulation, and the influence of information asymmetrics on corporate disclosures and investment. Welcome, Peter.
Thanks. First, let me thank everyone here at the Stanford Center for Professional Development. It's a great opportunity to be here, and thank you for hosting this. And thanks to all the participants for joining in, and I look forward to today's session. I was asked to give a general interest finance talk today, and when you're a finance professor, there's a big occupational hazard. Pretty much anybody, anywhere will stop you to ask for investment advice. You know, what are interest rates going to do? What do you think of this stock pick? My cousin's a doctor and has more or less the same problem, although he says the good thing is whatever advice he gives, 90% of all ailments go away on their own and he gets the credit. Unfortunately, as a finance professor, when things go well, people think they're the geniuses and only blame you when things go wrong. So with that caveat, let me tell you a bit about investing in financial markets, what the data shows, and some important mistakes to avoid. Much of what I'm going to say, many of you have heard probably in some form before, but you may not have fully come to appreciate their implications. I'm going to start. I'm going to start with a picture that you've probably all seen in some form. It's probably the most famous picture in finance, and that's the historical performance of different types of investments. What we're going to do is go back in time to 1925 and imagine we're our grandparents or great-grandparents investing on our behalf. And so suppose we had $100 to invest at that time, and we start with the most conservative investment, Treasury bills. If we put $100 in Treasury bills at that time, by 2012 it would have grown to almost, it's a little over $2,000. Now that seems impressive until you think about what happened to prices during that time. Let's plot the Consumer Price Index over the same period, and you'll see that you'd need almost $1,300 today to have the same purchasing power as $100 in 1925. So investing in T-bills would have increased your purchasing power, but less than doubled it. Okay, let's suppose instead we invested in corporate bonds rather than government bonds. If we look at what happened to a $100 investment in corporate bonds over the period, we'll see it would have grown to over $20,000. In other words, about 10 times as much as we would have gotten in government bonds. Let's take a look and compare now to stocks. If we had invested $100 in the S&P 500, which is a portfolio of the 500 largest stocks in the market, that $100 investment would have grown to about $275,000. Again, a more than 10x improvement over what we had with corporate bonds. Finally, let's look at an investment in small stocks. $100 invested in small stocks back in 1925 would have grown to over $2 million today. And again, another 10x improvement over that investment in large stocks. So this picture makes a pretty compelling case for considering investing in the stock market. But if you look at it closely, you'll see it tells another and perhaps even more important story. While we might expect these investments to rank in this way, over shorter horizons, there's no guarantee. There's a great deal of risk involved. Okay? So let's just take a look at a couple of examples of that. Let's go back to imagine we were stock market investors in 1929. If you had invested in the stock market in 1929, that's that blue curve that you see here, it would have taken until roughly the end of World War II before that investment would have turned out better than just keeping your money underneath your mattress over that period. So quite a long horizon you would have had to wait to see some benefit from your investment. Let's take another more recent example. If we go to the stock market in 1999, and again, as this picture shows, we expect the stock market to outperform bonds, but if you had switched to corporate bonds in 1999, that investment would have come out way ahead, even a decade later, than where you are in the stock market over this period. And it's only very recently, in the past year, that we've started to see the stocks make gains relative to bonds, much more recently. One more example to take a look at is small stocks. Suppose back in the early 80s, you had seen this graph up until that point in time and got convinced that small stocks were a great investment opportunity. If you had switched to small stocks in the early 1980s, you would have been sorely disappointed with that investment choice over most of the next 30 years. And it's only very recently that small stocks have started to come back and make gains relative to larger stocks. So, as I said, this picture is really hiding a fair amount of uncertainty, a fair amount of risk. Another way to understand that is to take the same data and present it a bit differently. Let me provide you with a histogram showing the frequency of different levels of annual returns for these different types of investments. For example, let's look at Treasury bills. If we plot out the histogram for Treasury bills, it looks like this. And what you'll see is that most of the time, you earn between 0 and 5% investing in Treasury bills, some of the time between 5 and 10%, and a few years you were able to earn between 10 and 15% investing in Treasury bills. That was back in the early 80s when interest rates were quite high. But overall, a very tight distribution, not a lot of variability in the returns for Treasury bills. If I compare that to corporate bonds, you see a bit more spread out distribution. Some years you actually lost some money in corporate bonds through defaults or downgrades. Other years you might have made quite a bit more in corporate bonds compared to Treasuries. Applying the same data for stocks, we see an even wider distribution. Here, the annual returns range between minus 50% to plus 50%. And of course, as we probably expect, small stocks are going to show the widest distribution of all, the most volatile of these four investment categories. Now, we can measure the variability in terms of the standard deviation of these annual returns, which we refer to in finance as the asset's volatility. So volatility is just another word for standard deviation of these returns. And you can see that we have the same ranking as we saw in performance, the least volatile being Treasury bills, then corporate bonds, then large stocks, and then small stocks. Now, I can take both of those observations and put them together in one figure, like I show here, where on the vertical axis, I've plotted the historical average return for these different investment categories. And on the horizontal axis, I've plotted their historical volatility. And I've thrown in a couple of other investments as well, a worldwide portfolio of stocks together with a mid-cap stock portfolio, just so you can see how they align as well. And what you can see immediately in this picture is a trade-off between risk and return. And that's exactly what we should expect. Because of their higher volatility, for example, to attract investors, small stocks need to offer a higher average return. Otherwise, investors won't invest in them. Another way of saying this is there's no free lunch in the market. If you want the higher return of stocks, you're going to need to accept the risk that goes with it. You're not getting something for nothing. That higher return is a reward for your willingness to take risk. Indeed, if we draw a line in this picture through Treasury bills and the overall market portfolio of the S&P 500, which we'll think of as a proxy for the broader market, we get what is called the security market line. And this represents the risk and return opportunities that are available to investors by investing in the stock market. You can choose where you want to be on this line based upon your risk tolerance. You can either invest more in the stock market or more in treasuries to locate somewhat lower down on the line or somewhat higher up, and even leverage your position in the stock market if you want to, if you're willing to take a lot of risk but hope for an even higher expected return. Now, that's basically the menu that's available to you as an investor. And what I want to point out is that it's really hard to get above this line. Very few investment opportunities offer sustained returns in the region up here above the line. Every now and then, an investment opportunity will appear that does seem to offer very high returns with very low risk. But most often, it turns out to be an illusion. The point I've plotted here is actually Madoff's reported returns, and we know what happened there, right? It was really just a Ponzi scheme. And so, in general, it's very hard to find investment opportunities that are consistently above this line. Okay. Now, while it's really hard to get above this line, it's very easy to wind up below it. If I plot individual stock and investment portfolios, you'll find something like this. Okay? So lots of individual investors and portfolio strategies end up well below the security market line that I plotted. In other words, individual investors are often taking excessive risk or sacrificing return by making some basic errors. And by doing so, we'll end up well below that security market line that I just showed you. Okay. And what I want to talk about today is some of the errors that people make and how to avoid them. How do we end up below this line, and how do we avoid doing that? Okay. In particular, what we'll see is that individuals often end up taking excessive risk by holding concentrated portfolios and trying to engage in market timing. They'll end up sacrificing return by paying too much in fees and trading costs, again trying to market time, and also exposing themselves to adverse selection. And I want to give you an insight into each of those so that you can understand how those errors can creep into your portfolio. Okay. So let's talk a little bit about how individuals investors behave and what are some of the common mistakes that they make. Well, the first one is very basic. When we look at the portfolios of small investors, what we tend to find is that they're very under-diversified. Many just hold one or two stocks in their portfolio. Often, it's the same stock of the company that they're working for. I sometimes refer to this as the Enron problem, in allusion to the energy trading company that collapsed back around 2000. Many of their employees had most of their retirement savings in company stock. And so what happened was they lost their jobs and their retirement savings at the same time. So in some sense, being doubly undiversified. Now, it turns out that you can cut your risk by more than half without sacrificing returns simply by trying to spread your investments out, diversifying to different industries, different locales, etc., spreading those investments around. It's not too hard to get rid of more than half of the risk that you would take investing in the stock market. Okay. So that's one obvious implication, I'm sure one that you've heard before. The other thing I want to mention is something we see in the pattern in the way individuals trade. When investors buy stocks, what we notice is that they tend to sell the stocks quickly when they go up, whereas they hold on to them when they fall. Now, there are a couple of interesting things about that. First of all, it tends to be a tax inefficient strategy. For tax purposes, typically what you'd like to do is defer realizing your gains so that you can delay paying taxes on your gains and accelerate the realization of your losses so you can get tax credits for any losses that you've incurred. And so it doesn't make sense from a tax standpoint. But it could make sense if investors know something. If the stocks that they sell when they've gone up have finished their run, their upward run, and they're holding on to stocks that have fallen because they expect them to turn around. Well, if we look at the actual data, this is what you find, and this is from a study by Odine and Barber. What they find is that if we look at the stocks that investors sold and looked at how they performed over the rest of the year after investors sold them, compared to the overall market, those stocks that investors sold tended to continue going up relative to the market. In other words, investors seem to be selling the winners too quickly. And on the downside, if we look at the losers that investors are holding in their portfolio, again, relative to the market over the remainder of the year, those stocks seem to continue to underperform the market. And so they're hanging on to losers too long. Okay. And so we see this asymmetry in investor behavior. It's tax inefficient, but even more importantly, it's costing them in terms of the returns, selling the winners too quickly, holding on to the losers longer than they should. The other thing that we see when we look at individual traders is that individuals tend to trade a lot, especially men, especially single men. Why? Well, most things in life, you add value by doing something. And so presumably traders have the same feeling. The annual turnover numbers, by the way, here represent the fraction of shares in their portfolio traded in a single year. Now, as I said, people feel like they need to do something in order to add value to their portfolio. But guys, you should only do something if you know something. And if we look at performance, it actually doesn't look so great. So sorry to show you this. but in fact, just compared to holding a basic market index fund, most of those individual investors are underperforming on average, and single men doing worst of all. Now, that picture doesn't tell the whole story because I haven't yet added in fees that they have to pay, trading commissions and the like. When I add in fees, here's the picture that you see once I've included in those transactions costs. So a lot of trading activity, but at least on average, it's not working out so well for these individual investors. And that's a general pattern that you tend to see. If I look more generally at investors and the frequency of their trades, the amount of turnover in their portfolios, what you find is that average performance tends to decrease with the amount of turnover. The more actively they're trading, they're doing worse, partly because of exactly those fees and trading costs that they have to pay. This bracket, the fifth quintile here, these are those single men I was talking about. Studies have looked at this group more closely and found that these folks tend to, be much more likely at doing other risky and impulsive things, get more speeding tickets and so forth than other folks on average. So there seems to be some sensation-seeking behavior going on there as well. So hopefully they're enjoying doing all that trading. Their portfolios aren't necessarily benefiting from it. Okay, let me tell you some other things. Obviously, we've shown it doesn't pay to trade randomly, but suppose you do your homework. You read the Wall Street Journal every day. You just trade when you learn some good or bad news about a company. Well, like that old adage, buy the rumor, sell the news. By the time the news comes out, the price is already adjusted and there are no more gains to be had. Let's take just a quick look at that. If we look at good news that's announced in the Wall Street Journal for individual companies, day 0 here is the day that the announcement appears in the Wall Street Journal. And what you'll see is that, once we're at that point, if you were to buy the stock at that point in time, there's really not much upward movement that you should expect in the stock price going forward. That the good news has already been incorporated in the stock price by the time it's in the newspaper. If we look at bad news, we see a very similar phenomena. Again, by the time that bad news is out there, it's, again, already incorporated in the stock price. We're not going to make any money by selling the stock at that point in time. And so, again, just be wary of trading on public information. The evidence shows that there aren't many gains to be had from doing so. Okay, so the other problem with active trading, in addition to just the transactions costs and tax consequences, is that you're exposing yourself to what we refer to as adverse selection. And the point is that whenever you buy, you're filling someone else's sell order. And only one of you can be beating the market. So while you may think you're picking stocks, it's potentially more likely that you're the one being picked off by a more savvy investor. Okay. A recent scandal just kind of reminds us of this happened with Goldman Sachs. A trader there, Fabrice Torre, sometimes referred to as Fabulous Fab, was selling mortgage CDOs to the banks and had convinced the banks that they were the ones picking the mortgages that were going into their portfolio, when actually the mortgages that they were getting had been handpicked by famous short seller John Paulson on the other side, who made about over $1 billion on those trades. And when that was revealed, Goldman Sachs suffered in terms of their reputation and so forth with their customers. But the general point is a good one. Whenever you're out there trading, there's someone who's likely to be someone informed who's trading on the other side. And you've got to decide, are you the one who's smarter than average, or are they really trading against you and picking you off in the process? Let me give you sort of a concrete example of this adverse selection problem in the context of IPOs. You may be aware that most IPOs tend to go up on the first day. In fact, if you look historically over time, you'll see it's a pretty consistent pattern that IPOs go on average about 15% the first day. There's an upward jump in the stock price when they first start trading. Now that might suggest that we could make a lot of money simply by investing $10,000 in every IPO that comes out. If we look at, roughly 100 IPOs per year, if we made $1,500 in each one, that's about $150,000 per year that we could make if we follow this strategy and could enjoy those 15% returns. Well, not so fast. It is true that IPOs tend to go up on average by 15%. But first of all, they don't always go up. So if you look at it, some of them go up by more than 15%, but some actually fall in value. Anybody remember Facebook, right? And Facebook did not go up the first day. It actually had a decline in value the first day. And so while the average return is 15%, there's actually some variability around that. So let's just take kind of an approximate distribution here of saying about 80% of the time they go up, and they go up on average of about 20%, and about 20% of the time those IPOs fall on the first day and may go down on average of about 5%. Now that still leads us to a 15% average return if we just do the math here, multiplying each row and then combining them, you get about a 15% average return. So why can't we make money doing this? Well, the problem is if we look at the allocation that you're going to get in the IPO, you're not going to be able to invest $10,000 in every IPO. Why is that? Well, because the very successful IPOs tend to be oversubscribed. And while you might put in an order for $10,000 worth of the stock, your broker may only be able to deliver a much smaller amount, say $500 worth of the stock. It's not unusual for very popular IPOs to be 20 times oversubscribed. That is, there's 20 times the demand for the number of shares they actually have outstanding. And so you're going to get only some fraction of the amount that you requested. On the other hand, the less popular IPOs, the one where the price is likely to fall, your broker is likely to come back and say, you know what, I was able to fill most of your order. I got you $8,000 worth of that IPO. Now, of course, we don't know which are going to be the most popular ones up front, and so if we now do the math and look at the allocation we actually get, multiplying again each row and adding up, we'll see that we're not actually making any profit in this situation because we're experiencing adverse selection. We're getting much less of the very successful IPOs and a much bigger allocation of the less successful ones. And the more informed traders basically taking that profit, not leaving anything left for us. So again, sort of this, even though we know that the average returns look good, just a naive investment here would not pay off. Okay. One last piece of evidence I'll show you. Some of you may be familiar with the show Mad Money, and there's a recent study that looked at Mad Money recommendations and again found kind of a similar pattern. That is, when they looked at Mad Money recommendations for stocks where there was news, what they found was that news was already incorporated into the stock price, and there were no real further gains to be had if you traded on that Mad Money recommendation. On the other hand, if we looked at stocks for which there was no news and Mad Money was making kind of an independent recommendation, independent of any news announcement, first of all, these tended to be smaller stocks, but what you found is that people who bought into those stocks, they tended to be overhyped initially, and that over the next several weeks, stock tended to fall. And while there was overall a persistent positive uptick in the stock price, getting in with the crowd, sort of herding with a bunch of investors all trying to get in, meant you might be overpaying up front and actually losing a few percentage points over the next few weeks on average as some of that hype dissipated. Okay, so we've talked a lot about some of the traps that individual investors fall into. What about professional investors and mutual fund managers? What does performance look like there? Okay. Well, let's take a look at that next. And here's an interesting picture. If you look at mutual fund performance, what you'll find for average mutual fund performance, if we looked at actively managed funds, is that they too tend to underperform just a broader market index portfolio. Okay, on average by about 0.5% per year over all categories. We'll also find that the underperformance is closely related with the fund fees. That is, the higher the fees the fund charge, the worse your performance. So in some sense, the reverse of you get what you pay for. Here, paying higher fees only got you worse performance. Okay. And that's an interesting observation I think many investors aren't aware of, that simply investing in a mutual fund at random or an average mutual fund is likely to be worse than investing in a simple market index. Now, it doesn't mean it's impossible to beat the market. There could be some funds that do beat the market, but it does suggest that doing so is either likely to be luck or otherwise based on something unsustainable, or perhaps involve hidden risk, or finally be something, based on something that's hard to copy. That is, a fund manager would need to have access to, information that others don't have, or some unique investment opportunities, have special trading efficiencies that they can exploit, or some unique talent in interpreting the data. Now, of course, this is what we hope for, is something in this last category where it's really something sustainable. But the real question is, if the manager does have some unique talent like that, why would the fund manager give it away? Why would they give that benefit to their investors rather than charging for it through their fees? And in fact, that's what we seem to find. Even those managers who do have talent and are able to beat the market are charging more in fees than the amount by which they outperform. Let me show you another picture that kind of highlights this. If we look at institutional fund managers, these are fund managers who manage stock investments for pension funds, endowments, etc. And if we look at past performance before they got hired, say by the pension fund that's hiring them, their past performance does show them beating the market on average by about 3% per year, which is significant given that the average institutional fund manager only beats the market by about 60 basis points per year. That's that average line I have in there as well. And so this is exactly what you'd expect. Pension funds are hiring managers who are outperforming, who look great relative to the average. So what do you think happens after they get hired? If we look at the data after they get hired, well, if we look at that data, what you see is this picture. In other words, this is what we call regression to the mean. Their performance after being hired looks a lot like that average performance. We don't see a persistence of the superior performance we saw beforehand, which suggests one of two things, both probably factors. One is that past performance was in large part luck and unlikely to be repeated. And number two, even if there was some component of skill, these fund managers have now been hired to manage a much larger portfolio than they were managing before. And it's difficult to sustain the same relative gains on a much larger portfolio. Okay. Now, you will note that they still are on average, though, beating the market by about 50 to 75 basis points per year. But the typical institutional fees are about 50 basis points per year. So this amount by which they're beating the market more or less is in line with the fees that they're charging, suggesting very little of that benefit is going to the ultimate investors. Okay. Let me give you, I've talked a lot about why it's hard to make money actively investing in the market, trying to pick stocks and time the market. Let me give you a very simple logic for why passive investing, at least on average, must always win relative to active investing. Okay. If you think about the market, and let's segregate it into two types, passive investors who simply hold the market index, and active investors who are picking stocks, going in and out of the market, trying to time the market. If we look at the passive investor, obviously they're just earning the market index return. What about the active investor? What are they earning on average, that pool of investors? Well, of course, if we look at the overall market, which includes both passive and active investors, what's the average return in the overall market? Well, that has to be the market index return again. The average of the entire market must just be the market index. And so if we look at this equation here, for these two to average out to the market index, it must be that on average, active investors are also earning the market index return, except that they're paying trading costs, they're paying for tax inefficiencies because of the high turnover in their portfolio, and as a result are going to, on average, underperform between 2 to 5% relative to the overall market. And that's just a simple math that there's no way to avoid. Okay? So on average, the pool of active investors must be underperforming a simple index fund or passive strategy. And the only way that some investors might be beating the market is that other investors are in there in that active pool who are willing to lose to the market. Okay? And so you just want to make sure you're not one of those investors who's basically providing the opportunity for some of those other active investors to win out. Okay. Let me look at one last phenomena, which is an interesting one. So here we've talked a lot about the average fund manager, the average institutional fund manager, and so forth. Can we do better? Can we kind of look at past performance and try to find out who is it that's got hot hands, who's doing well in the market now, who should I put my money with? Is there a way to kind of identify the winners and invest with them? And in particular, can we use past performance to try to pick winning funds? So let me just tell you a couple of stories along these lines and tell you what the evidence shows. So first of all, let's take a look at the following. So investment newsletters. Investment newsletters often provide advice on which stocks to invest in and so forth. There was a study that was done that looked at a decade of performance, so 1990 through 2000, and what the study did was the following. Each year, we looked at which was the best performing investment newsletter from the prior year. Okay, so which investment newsletter had the most outstanding returns, and then we're going to follow that newsletter's recommendations in the coming year. Okay, so we're going to do that each year over the entire decade. Find the best performing from the prior year, and then invest in that newsletter in the coming year. Okay, let's see what happens if we follow that strategy. Now, if you invested in the S&P 500 over this decade, over the 90s, a $100,000 investment would have grown to about $500,000. It was a great decade for the stock market, as we all know. If you had followed the best performing newsletter strategy, a $100,000 investment would have grown to $70,000. Okay. Not a very good performance indeed, and in some sense, if we step back and think about it, we probably shouldn't be all that surprised. So why do I say that? Well, if you think about what we're selecting on when we're finding the highest return investment newsletter from the prior year, what's the main thing we're probably selecting on? We might be selecting on skill, but we're most likely selecting on risk, right? How do you get to be an outlier? Well, you did something really risky and you got lucky. And so we're probably selecting on newsletters who invested in very risky portfolios. And if we follow those newsletters in the coming year and they take similar risks, there's no reason to expect that their luck is going to go the same in the coming year as it did in the prior year. Okay. So that's a really important observation, that whenever you're looking at past performance, if you're just looking at absolute returns, you're in some sense selecting on risk, and probably selecting on risk much more than you're selecting on skill. This reminds me of a story of my niece was taking an economics class in middle school, and they were doing a stock market segment, and the idea was each student was supposed to pick a portfolio, and at the end of the month they would see whose portfolio did the best, and whoever did the best was going to win a prize. I forget what it was tickets to some local concert that was going to be happening or something like that. And she was very interested in this and really wanted to win this prize, and so she came to me for advice. And so, against my better judgment, I thought, okay, let me see if I can help her here. And so I asked her, well, there's a prize if you win, what happens if you lose? And she said, well, there's no penalty if you lose. It's just kind of a fun thing for the winner. You get these concert tickets and so forth. And so I said, well, if your only goal is to try and win, the best strategy is let's find some really, really risky penny stocks, and we're going to leverage the heck out of your portfolio. And, with basically 50-50 chance, you're going to get lucky and you're going to have astronomical returns, and another 50% chance you're going to get unlucky and lose everything, but you don't care by how much you lose. And so it took her a while to get this, but in the end, she sort of got the logic of it, thought this was a great idea, and so we found some stocks, we leveraged it up, and all looked good until a week later she came home from school with a note from the teacher in tears, and apparently the teacher was upset because she had demoralized the rest of the class because her portfolio was doing so well, no one else felt like they could catch up, and it kind of ruined the spirit of the whole exercise. And so we couldn't win anyway in that sense. So just something to keep in mind, again, when we're just looking at absolute performance, fund managers have an incentive to take extra risk just to look good and get that attention, but you don't want to be picking your funds based on risk. So let me tell you something, another more sensible selection strategy that we might follow, right? And if we look at Forbes and Morningstar, lots of services provide a ranking of mutual funds where they don't just look at absolute performance, where they try to look at an assessment of risk in the past, and based upon both return and risk, try to say, well, who's delivered good performance given the level of risk that they were taking? And so, for example, Forbes has an honor roll of outstanding mutual funds, and there are other similar, Morningstar has their star categories and so forth, where they try to rank mutual funds on this basis, doing something much more sensible, trying to look at risk and return. This is obviously a much better thing to do. We want to weight in both risk and return in our recommendations. But how does that work out? What's the persistence there? Well, there was a study, a famous study, looked at these honor roll funds and said, what if we invest each year in those honor roll funds for 25 years? So each year looking at those that are most highly ranked in the honor roll and then follow those funds in the coming year. If we did that for a 25-year period, our annual returns over the period of study would have been about 13.6%. That's quite a nice return. Now, it's a bit of an overestimate because I'm not counting sales loads and fees in here, and as you move from one mutual fund to another, you may have had to pay some fees and would have had tax consequences and so forth. But if we look at the overall market over the same 25-year period, you would have found in the stock market about a 14.3% return, just investing in the S&P 500 index. So again, what you see is, while that ranking is much more sensible, there's still not a lot of persistence and not enough to overcome the fees and other charges that you pay in these mutual funds. It's very hard to predict the winners. Okay. Let me just give you one last very specific story on this point, and this is the story of Bill Miller's Legg Mason Value Trust Mutual Fund. And Bill Miller was very famous in investment circles, and let me tell you the story of why. His fund started in the mid-1980s. In early 90s, really started to do well with the fund. He had about $700 million on assets under management in the early 90s, and started to outperform the market. And each year, from 1990 through 1998-99, Bill Miller beat the overall market. So every year had superior returns to the overall market. In 1998, Morningstar named him Manager of the Year. In 1999, Morningstar named him Manager of the Decade. And Bill Miller started to become very famous as, the mutual fund manager out there with persistent performance, persistently beating the market, was onto something that was real and that was going to continue to deliver value. And that was true. That continued from 2000 through 2005, even though the overall market didn't do so great with the dot-com bust. Through that period, Miller continued to beat the market every year. Even when it went down, he went down by less than the market. When it went up, he went up by more than the market. And so at the end of 2005, Fortune Manager named him the greatest manager of our time. And by 2007, Bill Miller had over $28 billion in assets under management. Okay. Now, in 2006, his lucky streak broke. He didn't quite beat the market in 2006, but performance still looked good up and through mid-2007. And I said, attracting a lot of investor attention, $28 billion under management. What happened to those investors who jumped in at that point? Well, the fund did not do very well in the market crash. And this is what happened during the market crash. The overall market down about 50%. Legg Mason Value Trust down about 70% during this period, basically giving back all the gains that had been earned over that 15-year period through the crash. And a couple of years later, Bill Miller eventually retired, and retired at the end of his career with a slight positive performance, average performance over the S&P 500. If we look over his entire career, beating the market by a little bit. But his investors, on average, did not fare so well. Why is that? Well, if you remember back here, I said the fund had about $700 million under management, i.e., there weren't that many investors who got to experience the bulk of this run-up, where we were beating the market, where the fund was beating the market. But we had $28 billion in assets under management here before the fall. And so a lot more investors participated in the fall than participated in the run-up. And so if you look at the average investor performance of investors who invested in this fund, they were actually well below the market over this period. And again, that's that market timing aspect that I mentioned to you. Unless you're in it all the time, your average performance might look much worse than the average performance of the fund or the investment itself. Okay? So that's an important lesson from the market. And again, what the evidence seems to show is that overall there's very little predictability on the upside. There's very little ability to predict which funds, which managers are going to do well going forward. There is, however, some persistence in mutual fund returns. However, it's not the kind that's very helpful. In particular, the persistence we do see is that the very worst funds, those in the bottom quartile, tend to stay bad. And the reason is that typically that really bottom performance is based upon very high trading fees, very high commissions and the like, and those things persist and so are likely to keep them in the bottom quartile going forward. So hard to pick the winners, but don't get trapped in the losers. Pay attention to those fees. Stay with a very low-cost fund that's not trying to do anything very sophisticated, and you're likely to be better off. Okay, so some final thoughts on all this. Key things to remember. First, we can't all be above average. For one investor to beat the market, another must lose. So I think a useful visual to have in your mind whenever you're thinking of picking stocks or trying to time the market is, think about Warren Buffett sitting on the other side with his friendly Nebraska smile, happily taking your trades on the other side. And so, you've got to be confident that you're better than the average smart investor out there who's on the other side of your trades in order for you to think that you can make money by doing that. In general, it pays to be passive. By holding that market index fund, you're going to guarantee that you're on that security market line. Okay? That security market line is a good place to be. As I said, it's very hard to be above that, and it's really easy to fall below that whenever you deviate. Only be active when either you have good reason to be different. So, you might have very different portfolio needs than other investors. Your job is heavily invested in the tech sector, and so you might want to have a portfolio that's less invested in the tech sector to diversify from that. In terms of the timing of your investment, you should be investing on a regular basis and only withdrawing funds when you need them to make a down payment on a house, to pay for college education, etc. Don't be trying to go in and out of the market in response to, fears of a crash or things like that. You're more likely to be crowding with the herd and actually sacrificing returns if you do so. Or if you have very good reason to think you're above average, you're an industry expert in a particular topic. Well, if you do think you've got some insight into a particular industry, a particular firm that others don't have, that might be a good reason to trade. But just remember, you're playing poker with the pros when you do that, and so you've got to be really confident to do so. And finally, beware of fees. As I mentioned, active managers often take more than they add. There are fees when you're trading on your own. And just be careful. Even 1% per year in either trading fees or commissions or payments to active managers, 1% per year doesn't sound like a lot, but over your career, that's going to add up to more than a third of your retirement savings, right? So I like to say, you're really funding 3 people's retirement, right? Yourself, your spouse, and your broker if you're doing a lot of trading. And so that's something that you just want to be careful of. So with that, let me just wrap it up and mention that these ideas and more are in a book that you can find where a lot of this material is drawn from. And let me turn it back over to the folks here at the Stanford Center for Professional Development.
Hello, Peter. Hello, everyone. Thank you, Peter, for that wonderful presentation. I'd like to introduce Paul Marca, the Executive Director of the Stanford Center for Professional Development. He is responsible for collaborating with Stanford faculty, industry experts, and corporate partners to develop the curriculum of graduate degrees, graduate and professional certificates and courses, and contract training for one of the largest universities continuing education organizations and distance education networks. So Paul will walk us through some of the offerings that we have available for you.
Thank you very much, Roni, and thank you, Peter. I had the pleasure of meeting Peter just this last year when Professor and President John Hennessy asked us both to serve on the Presidential Advisory Committee on Technology and Higher Education here at Stanford University. Much of this was to discuss those massively open and online courses. And certainly we believe that that may be a significant change. It's been great to talk with Peter about this. But more importantly, I think the School of Engineering and the Graduate School of Business have partnered together to create an online certificate program, the Stanford Innovation and Entrepreneurship Certificate. Many of the market fundamentals that Peter shared with you today will certainly lead to tools and techniques and perspectives that Peter will share actually in just a few moments regarding the course that he's going to be teaching, where investors can think about tools and techniques and perspectives as startups emerge and how to really think about those things. The program that we are excited to be delivering, this certificate program, as I mentioned, is being led by Professor Hayagriva Huggy Rao at the Graduate School of Business, as well as Professor Bob Sutton in Management Science and Engineering as part of the School of Engineering department here. And we've been excited to gather faculty from across the campus, leverage some of the best insights, and create this program, which will include not only exercises and assignments, great lectures from our faculty, but also some TA feedback where you can test your mettle and get some improved insights as you're moving forward with that venture journey. What I wanted to do, by the way, remind you that questions are still coming in. Thank you for those. There are some general market questions. There are also some specific questions for Peter on some perspectives on how innovators need to think about financing. So we may be able to get to some of those. I know there was some interest in that, certainly. The course that Peter's going to share, maybe give us a quick perspective on this, is titled Financing Innovation, Valuing Projects and Firms, and it'll be launched in September. And Peter, maybe I can turn back to you for just a few minutes to talk about some of the perspectives in the course, but maybe also answer some of the questions that are coming in about how you think about this relatively risky, perhaps, startup notion, and what models we might use to think about entrepreneurship and new ventures.
Great. Well, thanks, Paul, and it's a delight to get to work with you and also to be working with this online program. And I'm very excited about this new course. What we've been talking about today is a real focus on stock market investing. But in the course, we're going to focus on real projects and how should you or your firm decide whether to invest in a new product, develop a new technology, or make an acquisition. And what we're going to do in that course is really develop the skills to create a full financial model for an investment project and use it to both make the case to get our project funded, whether that's internally or externally, and then use it to analyze our investment and optimize the value that we're creating in that investment opportunity. So we're going to be looking at basically internal capital markets in the firm. How do you sell your project internally and try to get it funded? How do public companies and startups raise capital from outside investors? And how is their stock valued in the market? So a lot of the lessons that we talked about today in terms of a general perspective of investors in the stock market is going to be relevant there as we try to think about, well, how do we stand out? How do we attract that scarce investment capital of those investors who are looking to make a new investment? We're not going to assume any background in finance in the course, but by the end of this course, you're going to have the skills to build your own financial model in Excel and to evaluate your project or firm. So I hope you'll join me with that, and I think it'll be interesting for those of you who have an interest and want to really understand how to apply the tools of finance to thinking about investments in real projects and in real companies. Let me turn to a couple of the questions that we've had. And in particular, a couple of you asking, so bottom line, what is the recommendation and what are some good things that I should be holding in my portfolio? And first, yes, you might have gotten that a key takeaway that we found, as the evidence shows repeatedly, is that for non-professional investors, if this is not your main activity, that by and large, the very best thing you can do is to hold a broadly diversified, low-cost index fund. So something like a total stock market index fund that has very low fees. Vanguard, other firms provide these through mutual funds. There are ETFs that provide the same thing, together with a similar broadly diversified bond fund and perhaps an international fund, that those together should really form the core of your portfolio, and that by doing so, you're going to outperform, over time, outperform almost every other alternative out there by doing that. Mutual funds are a great choice if you have to trade frequently because you're investing small bits over time, or may need to take your money in and out because you can often trade without any trading costs whatsoever. ETFs are great for long horizon investors because you get to control really when you're going to realize the gains for tax purposes and so forth. And so that could be a better strategy for a very long horizon. But those are just some of the general recommendations. And the point is, it's really difficult to do that. It's difficult even for professional to beat that. It's difficult for professional fund managers to beat that. And certainly, if this is not your main activity and your main area of expertise, it's going to be very, very hard for you to beat that on your own. Some folks asked if you're interested in taking more risk, what do you recommend? And I would say if you're interested in taking more risk than average, a couple of things you can do. One certainly is have a larger portion of your portfolio invested in the stock market if you're comfortable with that. And so the amount you invest is a good way to calibrate the risk that you're taking. And in addition, you might be willing to, with a small part of your portfolio, take some active bets in things where you think you have some primary expertise. But again, that shouldn't be the major part of your portfolio. You don't want to sacrifice the big benefits of a diversification. So keep the bulk of your portfolio highly diversified. You can take a smaller portion and do some active bets with it. Another question was, can an investment advisor be worth it? And I would say, yes, an investment advisor can be worth it. The ones who are worth it are those who are going to steer you away from making the mistakes that we talked about today, who are going to prevent you from jumping on your emotions and trading on hype, going in and out of the market too frequently, getting you to stay the course and stick to a long-term investment strategy and stay with a highly diversified portfolio. That's really the best things that an investment advisor can generally do for you. And those things, if you're not disciplined enough to do them on your own, can well be worth the fees that they charge. For actual stock picking advice, though, the evidence is, I hate to say it, but those investment advisors aren't really making up for their fees in terms of their stock picking advice. So those are, again, just some general takeaways to be aware of. I know we're running short on time, so let me stop here.